Welcome everyone to our YouTube live. And so this week again, we've done our third podcast now. Let me just tell you a little bit about that. So this one was about factor investing. Now, of course, that's very relevant at the moment because the big moves we've seen in markets have been very much driven by different factors. Small cap growth's been punished a lot. Over the course of today, we saw large cap growth also affected, with Facebook selling off hugely due to its earnings disappointment, but also the fall in revenue that might happen because less people are now signing up for Facebook. So I think these factors are a great way to think about not just investing, but also for your existing funds, you can see how much they load onto a particular factor. So for any fund, you can say how much of this is growth, how much of this is value, what kind of loading does it have on those factors, and understand the returns much better as a result. And also the kind of environments in which those funds do well. So I think factors, very interesting. And of course, the podcast format's quite informal. It's quite fun. Whereas like this, actually, it's quite informal and I think it's a good way to learn. But it's more kind of, because it's audio, you can do it anywhere. So I think, for some people, I think that could be kind of interesting and fun. Anyway, so thank you to Michael Pugh, who does the podcast with me, who does a brilliant job of producing it and also asking really good questions, many of which, of course, he knows the answer to. But he's very good at creating this kind of rapport between us and teasing out some really interesting dialogue, I think. And of course, yes, we did mention sprockets again. We didn't manage to avoid it in episode number 3. So that's the podcast. I also have a cold. So if I stop talking before the hour's up, it's because I'm coughing. So don't worry, it's not COVID. I've done a lateral flow test. It's just a man flu. So I may have to pause halfway through this, or it maybe even end a little bit early because I do have quite a big cough. So I'll try not to choke while we're talking. And the other point, I guess, is, as usual, if you're somebody who's one of our supporters on YouTube, we'll push your question to the front of the queue, or you can do a super chat. Both of those, of course, help us financially. And so we always try and reciprocate by answering your question first. Now, don't forget to like as well and subscribe if you haven't already subscribed to our channel. And the first question actually is from Kishore, who actually has supported us over the last 4 years now. I think he was one of the first people to support us on PensionCraft when we first started. So Kishore's got a question about emerging market bonds, and in particular about China and India bonds. And what he's saying is that, are these a good diversifier in a global portfolio? Now, the difference between, say, Indian bonds from a developed market perspective is that they are denominated in an EM currency. Now, the value of your bond investment, if that foreign currency devalues, it reduces the value. It actually reduces the value of your investment when you convert it back into, say, sterling or dollars. So there is always that risk when you invest in emerging markets that there will be some kind of EM crisis. The rupee will lose value, say, or the renminbi, the Chinese renminbi, and that'll reduce the value of your investment. You don't run that risk usually with developed market currencies. I say that, but in the case of the UK, of course, we did have a fairly big devaluation of sterling in 2016 with the referendum. But generally, developed markets, you don't have big currency worries. So that's one worry. The second worry is political stability. So will that region continue to be politically stable? That's a bigger risk for emerging markets than it is for, say, developed, usually. There's also the corruption problem. That's less of a problem with government bonds, I'd say. But then there's also the kind of classification of the bond. So whereas government bonds in the United States are something that people flock to when they're scared, you can't say the same thing about emerging market debt. When people are scared, they don't rush off in the United States, say, and buy Indian government bonds or Chinese government bonds. They're very much classified as a risk asset in the minds of developed market investors. So that's why they're not a great diversifier for risky investments, such as equity or real estate investment trusts or any other risky asset or cryptocurrency, say. So they don't diversify as well as, say, developed market government bonds. So that's the first point. They are, to some extent, risky assets. They're not as risky as equity, say. They're less volatile. Also, in a crisis, they'll sell off less than EM equity. But they are certainly not as good a diversifier as developed market government bonds. And then the second part of Kishore's question is what indices could you invest in if you want to get exposure to Chinese or Indian bonds? And the choice is actually fairly limited. So, for example, if you're in the UK, in Europe, you can use just ETF, and I'll show you what I mean. So this is just ETF. It's a good way of finding funds to do a particular thing. So you could go for a broad emerging market fund, of which there are several, and that will give you exposure to a variety of emerging market bonds. You can either go for emerging market bonds denominated in dollars, so these are called hard currency emerging market government bond funds, or you can go for local currency emerging market government bond funds, which are denominated in their domestic currency. So, for example, Indian government bonds denominated in rupees, or Chinese bonds denominated in renminbi, or you get the idea. So hard currency, obviously, you have less of a currency risk. There's still a credit risk. With local currency, you run the kind of currency risk as well. So those are the things to consider. Generally, the expense ratios are quite high, whereas for developed markets, you'd pay about 0.1%. For these, you're paying about 0.25, you can see, all the way up to about 0.47, depending on the fund you go for. Now, these are broad emerging market government bond funds, or I think there are a couple of single country ones as well. So, for example, there are several Chinese ones. So there's one from Barclays, there's one from Goldman Sachs. There are quite a few now. It used to be the case that there was one big one, which is CBON, CBON, and that was available in the US, but European investors didn't have much choice. Now you can see we do have a choice, and this one is actually sterling hedged as well. So if you're worried about the currency risk, then this one does have that hedge in place, but the fee is quite high, presumably because of that hedge. The expense ratio for this one is 0.4%. So roughly, 2 times to 4 times the fee you'd pay for a developed market government bond fund. For India, let me get rid of China. Yeah, so I can only find one Indian one. But of course, India didn't let foreign investors invest in their domestic government bonds until quite recently. So maybe there'll be more of those in future. But the point of these is, of course, that the yield is higher than it is for developed markets. I don't know if we'll be able to see that here. If we look at the dividends, perhaps it'll... No, we can't see the dividend yield. But that would be higher than it would be for developed market government bonds. But these things, won't diversify as well as developed market equity, will give you a high yield because they have a higher credit risk and do have a higher risk. And you should be aware of those risks, of course. And I'm sure Kishore is aware of those risks because I know him well and he's a very smart guy. Okay, so let's go back to your questions. And we have some questions from supporters. So the first question is from one of our supporters who's been a supporter for some time, Hisham Daoudi, who says, how do long-term returns of commodities, oil industrial metals, excluding agriculture, compare with long-term returns of equity? Good question. I did talk about this actually when I did a video on gold quite recently, where I was making the point that if you look at, for example, any commodity, anything which is useful generally long-term just keeps in line with inflation. Because if it was less than inflation, its growth rate, then it would become just a ridiculously cheap commodity, and its price would, in real terms, fall to zero over long periods of time. And conversely, if its price increased faster than inflation, the commodity would become unaffordable. Whereas equity has beaten inflation consistently for at least 120 years. If for example, if you buy global equity, commodity hasn't. Commodities generally just keep in line with inflation. That's true of gold or any other useful commodity. Sometimes you have deviations above and below. You get these super cycles. You do get these short-term economic cycles as well, every 10 years or so, and superimposed on that. And then you get the kind of usual volatility, which is the daily noise from these markets. But I'd say that over the long term, what you should expect is that commodities would keep pace with inflation. Now, there are exceptions, of course. For example, at the moment, we've seen oil and energy commodities surge, and we've seen other commodities surge largely as a result of changes in behaviour due to the pandemic. A big lack of demand during the height of the pandemic, a big pickup 12 months later, which has created a huge year-on-year increase in inflation, and that's feeding through the kind of inflation year-on-year window across the world. So if the source of inflation is something like a commodity, then it actually acts as a pretty good inflation hedge, as it has been for energy commodities over the last year or two. So if you compare it to equity, generally equity is much bigger, the return, than it would be for commodities. For commodities, I'd really just expect it to keep in line with inflation, for developed market inflation. So you do get these kind of super cycles. As I say, recently we've had a big upsurge due to the pandemic, but long term, that's why platforms like Vanguard in the UK don't offer commodity funds. They're just a nice to have, right? Sometimes they give you a little tactical play, maybe an inflation hedge when commodities are surging, but you really don't need it. The core of your portfolio, equity and bonds, right? So yeah, interesting to sometimes play with commodities, but I don't think it's critical. And then the second point, which is kind of related to the first, which Hisham asks, is do they have a place in a long-term portfolio? What needs to happen before you sell? Well, for my fund portfolio, I've got a long dated future commodities fund from L&G, Legal and General. And that's been a very good performer, of course, because I put the trade on, I bought the fund in February last year, and it's up about 20, somewhere around 26% since then. And would I hold it in my portfolio for ages? Probably not, because of the reasons I've said. It really just keeps in line with inflation, and over the long term, I'd expect equity to do much better. So again, I think there's a kind of opportunity cost if you put money into commodities, which is that they'll underperform equity, probably, long term. The other way you can play it is buying companies which produce commodities, miners, and they at least offer you a dividend. But there, of course, you lose the diversification aspect, because one of the good things about commodities, at least a lot of commodities, is that they're not highly correlated with things like equity. So they do provide you with some diversification. But if you buy miners, say, those are suddenly risky assets which are very much correlated with equity markets because they are equities. So that's the drawback. But it does give you a dividend, whereas commodities don't generate an income. Plus, you've got the complication that you're buying exposure indirectly via the futures market. So you have to worry about things like roll cost on the futures curve. So things like contango, backwardation, that kind of thing you have to be aware of. And you want to minimize that roll cost when it turns against you. So there are various subtleties you have to understand, I think, if you are going to do this long term. But no, I don't think I'd necessarily have them as part of my long term portfolio. Certainly not my core. My fund portfolio, maybe, but not my core. What needs to happen before you sell? Well, really, it's about whether the narratives change, I think, because it is for me just a tactical play. So personally, I'd sell if I felt as if the idea that the demand for commodities was starting to wane and the commodity supercycle story was starting to not apply anymore. But of course, the supercycle lasts a long time. So, I'm not going to do that at the drop of a hat. So I think I'm happy to stick with it for now. The next question, also from one of our supporters, Dan Veneri. Thank you, Dan. Love your laugh and, of course, content on your new podcast. Many happy returns. Yeah, a lot of people have said during power hours, when I do one-to-one sessions, that I laugh a lot. I can't laugh during the videos when I'm kind of trying to, explain something. It would be a bit weird to just start laughing. So at least in the podcast, when Michael and I are talking, we laugh a lot. We laugh even more than you'd expect. In fact, there's a bit of a bleeper, a bit of a blue bleeper, which he only made available to Patreon supporters, which went down very well. And yes, I do swear. So if you become a Patreon supporter, you actually get to listen to that clip. Caused much amusement and slack. Anyway, so thank you, Dan. I'm glad you enjoyed our podcast. We enjoyed making it. So it's even better that people like to listen to it. Let me just have a bit of liquid. So don't forget to like and subscribe. And yeah. Next question's from another supporter, Rushar, who says, are the dollar, sterling and the Swiss franc, I guess, considered safe haven, your euro not? Okay, so just in the same way that you can effectively, have two buckets, risky bucket, safe haven bucket, and all assets fit into either one or the other. So in the risky bucket, equity, real estate investment trusts, many commodities like copper, oil would fall in the risky bucket. And then in the safe haven bucket, you'd have cash, gold, government bonds. All of those would be safe haven. And of course, the risky bucket would have crypto as well. Now, what would go into those buckets if we did the same for currencies? Well, in the risky bucket, we'd have the Aussie dollar or any kind of commodity currency where a lot of the GDP for that country is generated by selling commodities. A lot of emerging market currencies would be in the risky bucket. The safe haven bucket is much smaller. Primarily, it's got the US dollar, the Swiss franc, the euro. Now, more controversially, sterling, if you look at the behaviour of sterling recently, it's very much fallen into the risky bucket rather than a safe haven. Perhaps that's because of Brexit, perhaps it's for other reasons, but perhaps it's just weakness of the economy recently. But for whatever reason, sterling has not been a particularly effective safe haven currency. Now, of course, emerging markets generally would be in the risky bucket. What does that mean to us as investors? Well, if you're investing from a developed market country like the US or the UK, then actually let's do one of the kind of safe bucket countries, so the US. If there's fear in the market, then any foreign investments which you've got will actually devalue because the dollar will then strengthen, when people are scared. And that reduces the value of your foreign investments when they're converted back to the safe currency. So if you are one of the safe haven countries and currencies, then in a crisis, it'll exacerbate the sell-offs in risky assets outside your domestic currency. One of the good things about sterling no longer being a safe currency is that if there is a kind of scare in markets, sterling devalues, and because much of our investments are in foreign assets like dollars, then those assets actually increase in value more as sterling devalues versus the dollar. So really it depends on what your numeraire, your domestic currency is, as to whether it's good or bad that you're a safe haven. And of course, during good times, the safe haven currencies suffer. The investors in the safe haven currencies suffer because their domestic currency relatively weakens perhaps. And if it really depends on where your investments are as well. So US investors, because their market's so big, often don't even look outside the United States for investments. But for countries like the UK, usually we'll have a very internationally diversified set of investments. So currency certainly matters for us. So I hope that answered your question, Rushar. I see you paid us in Turkish lira, so I guess that's a particularly relevant question for you at the moment. I just hope you're not suffering too much due to inflation at the moment. It is pretty horrifying seeing what's happening to inflation in Turkey at the moment. So the next question, also from a supporter, thank you. Another long-term supporter, thank you, Gary. Gary says, it's about Facebook. Here we go. So Facebook lost 1/3 of its market cap in the last 6 months. It lost 20% over the last day due to a dip in DAU. What happened to all that blockchain-based digital wallet, Libra, Metaverse hype? Okay, I can tell you're not a believer, Gary. Okay, just personally, there is something I'd like to share about the Metaverse. And I think, if you have this idea of a virtual reality in which you can buy things, in which you immerse yourself every day, like the internet, think of it like a game. When I play a game, I usually play it for maybe a couple of months. I usually use open world games, which might actually fit very well in the Metaverse. But once I reach a certain point and I've done everything there is to do in the game, I get really sick of the interface. And at that point, I'm just itching to move to a new game. And I think that's the fundamental problem for creating a metaverse, which everyone uses. And the question is, which metaverse do you use? If it's like a game, you get sick of it after 6 months. You never want to see that interface ever again. And when a new exciting interface comes along, then suddenly you see the world in a new light, you learn new controls, the physics is different maybe, the interface is different. So I think that's the difficulty that the metaverse is going to face. Will there be one platform which we all adhere to, or will it be much more of an ecosystem of things which have to work together? And the question is, if it is an ecosystem in which things have to work together, can one company like Facebook dominate that ecosystem? Or will it be the tool providers, like the people who create 3D rendering engines? Will it be those people who create open architectures who actually benefit the most? And I suspect it's going to be the latter. I don't think there'll be a monolithic company which dominates all of our Web 3.0 interactions. I think it's much more likely to be a kind of ecosystem of open architecture systems that will be successful. Because there you can always upgrade, you can swap things in and out. A modular design would be much more successful. And also, from the point of view of somebody who sells stuff on one of these platforms, why would you tie yourself to the risk of being only able to sell on Facebook's metaverse, or Meta's metaverse, as it's now called? So I think that's a problem, a fundamental problem about large cap companies becoming the metaverse. I just don't think it's going to happen. The best they can hope for is to carve out a niche inside that ecosystem and maybe capitalize on that niche. We saw the same thing with their cryptocurrency. It's very hard to trust a company. And the whole point of many cryptocurrencies is the lack of trust. You don't need to trust a central counterparty. So I think it's wrong for them to try and do this. It's fundamentally misguided, if you like. So anyway, that's my take on it. And of course, the huge sell-off that we just saw is pretty shocking to see a large cap lose overnight the entire market cap of Netflix. That's how much after the market closed, that's how much the price went down for Facebook as a result of the earnings announcement yesterday. I actually did some sums. Turned out that if you look at the NASDAQ 100, the loss in market cap for Facebook over the course of, what was it, an hour, was equivalent to more than the market cap of about 80% of the NASDAQ. So not combined, but individually. So, I think it was pretty shocking. And I think people are just saying, look, the growth in earnings has been incredible, but where are we going from here? Because what we've got is people not really buying into Facebook anymore, unless people log into the platform. I think that really was the death knell for their bull story. But I mean, if you just look at the earnings which they generate and the growth they've generated over the past 10 years, it's incredible for a large cap company. But in this kind of environment, even a slight deviation from that perfect pricing is hugely punished. We saw the same with PayPal recently. So Gary, I think I'm with you here. I'm not particularly optimistic on the Facebook Meta future in the metaverse, or at least not the way they see it. Next question is from Dan Veneri again, who says, did you accelerate your purchase on your FTSE portfolio in the last 2 weeks? Okay, it's not a FTSE portfolio, it's a FTSE Global All Cap Global Index, which I have as my core equity holding. Did I accelerate it in the last 2 weeks? Or did you step back and wait to see how the market will behave in the next 2 weeks? I was actually very good. I stuck to my schedule. I have a diary reminder, I think it's the second week of every month, that says Ramin buy equity today. And I have to buy the same amount, same fund, every month. And I did. Have I accelerated it? No. Because valuations are still pretty high. I still don't think we've seen much of a correction. I think if we see, I don't know, another 5-10%, if we go down to the 10-year average forward PE for the S&P, if we cross that forward PE 10-year average, and if you want to see what that is, I've also done a video recently called Is Equity Cheap Yet?, which you can see on YouTube, where I actually work out what that forward, the kind of 10-year average level for the S&P would be. And I think it's about 30% below where we were at the beginning of the year. So we're still quite a way off that. But if we cross that point, I think I'd definitely accelerate my purchases. But so far, no, I haven't accelerated. I've just carried on buying. Because another video I did recently, I actually said, we'll compare two things. We'll either just drip feed $1 every month into the S&P, or we'll hold back our dollar if valuations are high, and the minute valuations drop below a threshold, then I'll go all in on my savings. And in no cases did the holding back money outperform the steady drip feeding, because valuation is just not a very good measure to determine whether you should invest your incremental income every month. So that's why I think, the best thing for most people is, as you earn, save as much as you can into equity and just leave it. I think that's probably what works best. And that's what I'm doing with my money. So, I hope that answers your question. Let me just drink a bit more. Right. Yep, don't forget to like and share. We've got lots of questions from our supporters today, so it's going to take a while to get to the actual other people on the call. Sasuke Uchiha, who's one of our supporters on YouTube. Thank you, Sasuke. He is a member for 2 months. Thank you very much. He says, do you think the S&P correction is over this year? Since the S&P 500 has averaged an intra-year pullback of 17.1% in midterm election years from 1950 data to now. Yeah, I don't think elections are that important, to be honest. I think politics is just background noise for equity investors, unless they do something really crazy. Generally, earnings growth is more important. Taxation probably has an effect, corporate taxation, but otherwise, yeah, politics doesn't have a huge influence, I don't think. But do I think the S&P correction's over? Well, it's certainly not cheap yet. So could it fall further? Yeah, I think that's quite plausible because equity just isn't supported by fundamentals at the current levels. It's cheaper than it was, that's all we can say. And I never make forecasts. You know, all I can do, like anyone else, is just say, I think this is likely, I think that's unlikely. So I think more than a 30% correction from the beginning of this year is unlikely. If you don't know why I'm saying that, then take a look at my valuation video. Is equity cheap now? But I just don't think there's that much bad news yet to justify more than a 30% fall. But is it over this year? I think probably not. You know, I think we could fall further. We'll just have to see what happens with the earnings season. Also look at because currently we're seeing the Q4 earnings for the end of 2021. In a few months' time, we'll start getting Q1 earnings for 2022. And the forecast so far is that that'll be very strong again, as will the next quarter after that. It's only when we get to Q3 that the forward forecasts start to really tail off. And at that point, I think we'll be in more trouble. Because simultaneously will also be a couple of Fed hikes in, probably, and earnings growth will be weakening a lot. So the second order difference in earnings growth will be negative. It'll still be growing, but just growing less quickly. It'll be decelerating earnings growth, which is usually a bad look for equities. So that's when I think we'll really get a potential problem. But that's at least 6 months away. Probably not. There's 9 months away at the moment. So there could be a bit of a rally between now and then, but then I think there'll be a kind of moment of truth. And at that point, I think, we could test the 30% fall relative to the beginning of this year. But of course, I don't really know, which is why I keep drip feeding regardless of the valuation. Good question, Sasuke. Next question from Stephen J, another supporter on YouTube. Thank you, Stephen. Who says, brokers charge €40 commission in my country. Oh my goodness, that's huge. Should I use Degiro, but it isn't regulated great if it goes bankrupt? Yeah, difficult to decide, Stephen. I think, if it's your life savings, the question you've got to ask yourself is whether you're willing to risk your life savings on an unregulated platform. I'd have qualms about that. That's not an easy decision. And I can't tell you what to do. I can tell you what I'd do. I'd probably go for the regulated platform. Because eventually your country as well, I don't know which country that is, Stephen, but I think your country too will have its own vanguard, if not the vanguard. Because they are going to expand into Europe. That is their plan. So I think this is the inevitable thing that's happening with every platform and every fund globally, which is fees are trending downwards. So I think that's true of platforms, it's true of funds, and no country is going to be able to stop that movement. They may want to, but I don't think they'll be able to because of the Vanguard effect. And if it's not Vanguard, it'll be some other competitor that undercuts them. So I hope, Stephen, that in your country, you get your own Vanguard, or at least your Vanguard effect, which is cheaper fees. So no easy question, I don't think. Degiro, I've just seen Laura highlighting the word Degiro. Degiro is regulated in several countries. So, for example, to operate in the UK, they have to be regulated here. So I check, actually, whether there are any regulations in your country, because I suspect they wouldn't be able to operate in the Eurozone unless they were regulated in some way. So just check whether that's true or not, because you may be surprised at what regulations there are. I mean, fortunately, we live in a region where regulations are pretty tight in Europe and the US as well. And those do protect us. Next question. Another supporter. Thank you. Cam Calderon, who says, "Hi, Ramin. I hope you're well. Unfortunately, bit of a cold. Bit of a cold, Cam. I'm not particularly well, but struggling on. What can I say? How many times do you think the Fed can increase the rates without inverting the yield curve? Regards from Leicester." Oh, lovely. So yeah, I think remember, the long end of the curve generally is driven by growth. So growth expectations. Let's have a look at it. I'll just fire up Coifin and share this with you. And we'll switch to yield curves and have a look at the US yield curve. So if we go back further in time, say 10 years, yeah, what you can see here is the lower graph, the lower curve is the US 1-year yield. The upper one is the 30-year yield going back to 2012. Now, generally what happens is the long end is driven by growth expectations, so here roughly 3%, and the short end is driven by the Fed policy, pretty much. So you can see the Fed was hiking at this point, then the Fed stopped hiking because of the repo crisis, then we got the pandemic, and we went down to zero low bound. Now there's talk of hiking, and the curve has effectively tightened for the Fed already. So one argument says that effectively the tightening has happened for the Fed already. The yield curve is doing the Fed's work. And this is how policy works, right? The Fed just says they're going to raise rates and yields increase even before they raise them. But the long end of the curve, notice, hasn't really moved up much. And that means to me that the bond markets are a little bit skeptical that we're going to get huge growth. So in order for this to invert, the Fed is going to have to hike a hell of a lot. Currently, the 1-year part of the curve is at 0.77 and the 30-year is at 2.2. So we've got over, 1.4, something like that, 1.5% to go of hiking before we get to a flat yield curve. And then you have to invert. So, we've got quite a long way to go for inversion. It depends on the kind of the part of the yield curve you use to measure inversion. So if it's 2s, 10s, obviously the numbers would be different. Here I've done 1s, 30s. So if instead of that, if we do 2s and 10s, there'll be less difference, obviously, because they're closer together in term. Here we're much closer to a yield curve inversion. So depending on which bit of the curve you're looking at, yeah, it could be that we don't have to go very far at all before you get inversion, at least in some parts of the yield curve. So do I think that's a problem? Well, yeah, because yields tell you what the market thinks about growth. And if the market thinks that growth is going to be lousy, then the Fed is actually hiking into a weakened economy. when really its policy should be more accommodative. So, that's a worry. So it may be that we don't have far to go at all, in answer to your question, Cam. Depending on where you look on the yield curve. But as we saw, the 2s, 10s are really not that far off. And the 2s are really shooting up, right? So the 10s have not moved much. So not far at all, in answer to your question, for some parts of the curve. Does that necessarily mean a recession? No. It's a very poor indicator of a recession. Historically, when you get a yield curve inversion, usually there is a recession, but it actually has generated false positives. And I think there have only been like 7 data points over the last 50 years or 60 years. So N is very small. The number of cases is very small, and there were some false positives in the 60s, I think. So yeah, it's not a great indicator. And really, I don't think the economy is that bad, certainly in the US. If you look at the employment data, it's pretty brisk. I mean, look at the level of unemployment, and it's at decade lows. It's only because it was so strong before the pandemic that we aren't cheering, less than 4% unemployment in the US. So the economy is pretty strong. I'd be surprised if we get a big recession. Maybe a short dip into recession would be the worst I'd expect. Next question is from Andrew O'Connell, another supporter. Thank you, Andrew. Let me just have another sip so I don't stop talking. Don't forget to like and subscribe. And of course, if you support us, you can always support us on Patreon and join our community. And then we can have these much more cozy chats. And of course, you can talk to me on Slack. And it's much more interactive, I think. But the next question is from Andrew O'Connell, who supports us. He says on YouTube, he supports us on YouTube. Hi, Ramin. Really like the look of both WIGG and GBPC high yield bond versus VCPA. However, confused as to why they've dropped so much. Inflation ? When does investing in either both of these stop making sense? Interest rates, inflation. My thinking is you want to buy these at a low price now so they pay off better in a year or so's time when inflation has reduced. Right, so let's have a look. Let's have a look at WIGG and see what you mean. So let's just hope I can find it on SharePad. Yes. So this is the Fallen Angels bond fund. And I'm going to share my screen. There we go. So this is compared with the S&P. We don't want to do that. So you can see it has fallen a bit, not a lot recently, but that is generally, remember these are risky assets, so they fall into the risky bucket. And if equity's selling off, as it has been since pretty much the beginning of this year, then credit spreads will widen too. And that's exactly what we've seen. And there's roughly a 60% correlation between high yield credit and equity. So it's not a great diversifier. It is a risky asset. So you would expect spread widening and a falling of these bonds. Now, the other thing to look at is the duration of WIGG. Now, unfortunately, finding the duration of these funds is a bit problematic. If this is we found a cyclist. That's not what we wanted. So we wanted the WIGG ETF. Yes, this is an iShares fund. So fortunately, we will be able to look up its duration because they've got a very good description on their website. Unlike Vanguard, let me say, of the duration of each of their bond funds. So the effective duration of this fund, I don't know if you can see that, is 5.22. Now for high yield credit, usually the maturities of these bonds, the lifetimes of these bonds are fairly short. It has increased in recent years, but it's still less than you'd expect for investment grade, say. So for this one, it's 5.22%. Sorry, 5.22 years. So fairly small duration. And so inflation will affect it. So if inflation increases 1%, the price of this fund would decrease by about 5%. So maybe inflation is to blame for that. It is also it's also exposed to interest rates. So interest rates we've seen yields increase very sharply. We can see that here. Interest rates increasing very sharply since the beginning of 2022, at the short end of the curve anyway. So if we look at the 5-year part of the curve, I suspect we'll also see an increase. Yeah, so the 5-year part of the curve is in orange, and that's really shot up. So it's probably a yield increase, and part of that's inflation, but that's why it's fallen in value. And I suspect the credit spreads have widened as well. Although the actual credit spreads that I look at haven't really increased that much. So if we do look at the credit spreads since the beginning of the year, so let's look over a 1-year period. They have widened a bit, but not a lot. So if we zoom in on this period, yeah, you can see them widening slightly since the beginning of the year, but not hugely. So that's also to blame. So really, it could be because real yields increasing, spreads have increased a bit, and inflation, of course, has not helped either. The second part of your question is about whether that's a buying opportunity. Personally, I think not, because I think we could see a further fall in high yield if risky assets sell off further, and we're also quite likely to see higher interest rates. So I might hold fire for a bit. But certainly, as you say, the time to buy this stuff is when it falls in price, because effectively you'll be buying into a fat stream of cash flows stretching forever into the future. And you'd rather buy that at a cheap price to get onto the bandwagon at a low entry fee rather than pay a high entry fee a couple of months ago or even now maybe. So I don't think this is a particularly cheap entry point. Just look at the yield and compare it with where it was during a distressed market. That'll tell you when it's kind of a good time to get in. 5% probably would be no, maybe higher than that. Maybe about 5-6% or even higher is when it starts to get really interesting. And if you get 8% on fallen angels, then that would be great. But currently, if you look at the yield, the 12-month trailing yield is about 4%. So still not incredibly cheap, I wouldn't say. So I hope that answered your question. Remember, you can like and subscribe. I'm going to have another swig so I don't start coughing. Another question from Hisham, who says, one more question. What's your outlook on emerging markets equity in 2022? Well, the overall story is reasonable growth, I think, globally. And, we are seeing things improve, but there are still supply chain issues. There are still leftover issues caused by the pandemic, which are still lingering for many emerging countries because they can't afford to vaccinate their populace as you can in Europe or the US, say. So the vaccination rates obviously are lower, and the effect of each wave of the pandemic is going to have huge effects on the availability to work, for example. So there are still some remaining issues, but global growth, I think, will probably be pretty good, not amazing, but okay. And the other thing that might be a problem, I guess, is the dollar will probably be quite strong, and usually that's not great for EM. As the US increases its interest rates, generally that strengthens the dollar, and that's generally a bad story for emerging markets. And if we've got less risk appetite, clearly, if people see a 20% fall in Facebook, they're not going to be running forward to put their money into Chinese equity, for example. So, risk appetite, high yields in the United States, potentially a stronger dollar, reasonable growth. That's the backdrop we've got. And that's not a screaming justification, I don't think, for buying emerging market equity. But would it be catastrophic? No, I don't think so. But I'm not sure I'd be piling into China right now, which some of my clients have been doing. I had some surprising calls where people were saying that, they were buying heavily into single stocks in China, which I personally would not do at this point. But still, some people are very contrarian. But I don't have that conviction, certainly at the moment. But I am very cautious. The next question is from Mick C, also a supporter. If there's another decade like 2000 to 2010, would it still be better to invest the same every month instead of waiting for the dips? Yes, because when there's a very strong rally, as there was, well, of course, 2000 was the beginning of the .com sell-off, and then you got the... Okay, so you're talking about that period when equity markets had an atrocious... Okay, yeah, I'm with you now. It took me a while to work it out. Well, your point is a good one, Mick, because the answer is no. The compelling case for... The case for investing continually wouldn't work if you knew equity markets were going down. But the problem is that period between 2000 and 2010, the double crisis, the .com crisis, and then the global financial crisis, those two came in succession. And just as markets were recovering from one, we got the second. And that's why it was such a huge drawdown period. So that's why I think that it probably doesn't make sense in that kind of environment to do gradual drip feeding if you knew that was going to happen, but you don't. You never know beforehand whether we're entering another awful decade. All you can really look at is valuation today, and that's a very poor indicator of future returns. It's not very predictable. Markets are not predictable, so you don't know what's going to happen in future. All you can do is look historically, and you can say that the average year equities gained 6% above inflation, maybe 5, maybe 6% on average. That's what they've done over the last century, and that should be your base case. Then you can layer other information on top, pandemics, valuation perhaps, political crises, but your base case is that 6% outperformance. So if you knew what was going to happen, yeah, you wouldn't be putting money into equity. But if I knew what was going to happen, I'd be short equity in 2000 and I'd be long, when it reached 2003, and then I'd be short 2006. If you knew what was going to happen, investing would be easier, that's for sure. But yeah, that's the problem, Mick. You don't know what it's going to be. And most of the time equity markets rally. So, if you are going to be investing for a decade or more, I think there's a very strong case to be made to put as much as you can into equity if you're comfortable with that risk. Next question is from Doug Helge Gunderson, who says, dollar cost averaging every month or every second week? Ooh. Well, the sooner you put the money in, the better. So, the minute you get the money, it should go into your equity. That way you'll maximize return. And that's because of the drift. It's just a mathematical fact that if markets are drifting upwards, the sooner you put money in, the longer it compounds. So, every second, you're not going to be able to drip feed that often, but of course, the sooner the better. And really, it's about convenience as well. I have to do these trades once a month. It's a pain. I have to log in. I have to enter the password, find the fund, click on buy. So if you have automated buys, maybe that's easy, but my platform doesn't. So yeah, so as soon as possible, Doug, is probably the best way to go. We've got a super chat from Simply Trades. This is the last question, which is actually taking us up to the end of the hour. I'm sorry about that. The question is, What do you think about the Aussie market and your outlook for 2022? Clearly, you can't divorce that from your views about China. Chinese growth probably will be good in 2022 and beyond by fiat, obviously, of the government. But, demand for... The question is whether China's zero COVID policy is going to dent their growth. If that's true, then that would be a bear case for Australia. The other bear case might be if they do pivot away from commodity intensive growth, which is likely because they want real estate development, which is not too super productive, to be on a kind of back burner to exciting new tech advances, things like AI, things like 5G, things like software development and maybe Web 3.0, whatever. If there is a pivot towards that, which is less commodity intensive growth, clearly that's not so good for China. That's not so good for Australia. Because if you're selling iron ore to China or other commodities, then the commodity intensiveness of their growth is critically important. So that would be a kind of structural worry about Australia longer term. And at the same time, we're seeing, I know I have many Australian clients who I've spoken to who tell me about crazy property prices in Sydney, in WA, and that kind of exuberance is worrying, because if China does pivot away from dependency on exports from Australia, that doesn't paint a great picture for Australian growth. So, there are structural worries, but primarily I'd be looking at what's going on in China and with the rest of Australia's trade partners, which are dominated by China. So, but for 2022, probably I don't see any immediate problems except for the pandemic and the zero COVID policy and whether that shuts down factories and slows growth. And also the policy of the housing market, whether that's going to impact demand for things like steel, for example. That's likely to have a knock-on effect. But, the Chinese government's backed down whenever it's tried to clamp down on the property market every time because it's so important for growth. So it'll be interesting to see if that happens again with the fallout from Evergrande. I think it is likely to happen because it's very difficult to make a whole country, even in China, it's very difficult to make a whole country pivot away from a very productive sector. And they do depend on either directly or indirectly on property development for growth in China so heavily. So that'll be very difficult to wean themselves off. So maybe they'll manage it. I do think that their pivot away from that is a good thing. And the choice of sectors they've got is also really interesting. So, but neither of those is great for Australia. So I'd be concerned if I was heavily invested in Australian equity or property, say. So that's good timing. A coughing fit right at the end after an hour. So thank you all for joining us. Do subscribe. Do like this stream. It helps us a lot. And don't miss our podcast because Michael and I put a lot of work into it. And we do laugh a lot, and you might as well. So I think that's a great way to learn about investment with a smile. So have a great 2 weeks, everyone. And we'll speak again in 2 weeks' time.